everybody know about stocks. Everybody knows about stocks. Everybody knows about, not everybody, but majority of us are familiar with stocks. We've heard about it, right? But you have this world of private equity. And my latest report I read here was that the publicly traded companies, we have 3,800 publicly traded companies, but we have 97,000 private companies in the United States. In Europe is even a bigger disparity there, with 4,600 publicly traded companies, things like Google, Amazon, Facebook, all of the good stuff like that, publicly traded companies that we know about and talk about. But there are 290,000 private companies out there. Can you explain to the listeners and everybody that's out there the difference between the private equity world and the public markets that we all know of?
Sure. The way I like to think about this is I use the analogy of a mutual fund. Most people have 401ks wherever they work. They kind of understand, at least in the U.S., some type of retirement plan, where you have Schwab, you have E-Trade, you got TD Ameritrade, pick a brand. You go online, you buy a mutual fund. What a mutual fund does is they aggregate money from a bunch of different investors, bunch of different people. And then a fund manager makes decisions about what companies to buy and hold within that portfolio as a part of that mutual fund. It's publicly traded, which means you can buy it this morning and be pissed off by it by the afternoon and sell it. You can keep it for 5 years, 5 minutes, or 5 days. You have total liquidity. And the real difference here is going to be that key word. It's liquidity. So a mutual fund can be traded. They're rated by Morningstar, a bunch of other different agencies, 5-star fund this. And so investors can log in, buy a piece, sell it whenever they want, hold it as long as they want, total liquidity. Now that's the public markets. I like to think of private equity as essentially a private mutual fund. You don't have any liquidity though. And typically for most private equity firms, the average investment size to play in private equity is around $5 million. And I've seen some funds that are as high as 10 to 15 million. And so, these are big investors. It's usually college endowments, college or university endowments. It's pension funds, public pension funds, or very wealthy families who make up the majority of what are called limited partners. They're the people who are investing in private equity. And generally speaking, in that mutual fund where you have total liquidity always, in private equity, most funds exist for a 10-year lifespan. And during that 10-year period, you have no liquidity. And you commit as a limited partner an amount of capital. So we use that $5 million as an example. And along with a bunch of other money collected from other investors, pension funds, college, university endowments. And then the firm may have raised a $1 billion fund, or you mentioned Partners Group. So they're probably a 10 to $15 billion fund because they're a big outfit. And then they have a general partner, which is the firm, and the firm makes all the decisions about what companies to buy and what companies, that they want to invest in. And then, during that 10-year period, it's kind of during the first 5 years, they're buying companies using your money. You don't put all that money in up front, as you're committing an amount of capital. And then as they buy a company, they say on a percentage basis of the fund, that you need to send, 1% of your 5 million commitment because we're getting ready to buy a company, or 10%, send me 500 grand. And so for the first 5 years of a fund's existence, more money flowing out from the investors as companies are being bought. Then during about a 5-year hold period, companies are being improved, they're being grown. And then at the tail end of that 10-year fund life, the last 5 years, first 5 years, money's going from you up to the private equity firm. And then for the last 5 years, it's kind of the money starts coming back to you as they're selling the companies that are held by that fund. And so it's a 10-year life of a fund. You think about our lifespan, and you start measuring it in 10-year increments, and it's like, these are big funds that make big investments, and they are held for a relatively long period of time. And that's why the minimum investment sizes are so high, because there's no liquidity. People have to be willing to part with their money for an extended period of time. So a pension fund has immediate obligations for retirees, and then they have future obligations for people who won't retire for 10 years, and they want a higher return on that money. And so they would pick kind of some alternate asset class like private equity, hoping to get a higher return. Has anybody looked at their bank account recently and seen what kind of savings interest rates you're getting? Yeah, I had American Express send me a thing, and there's like, open up this great account, put in a pile of money, and we'll give you 0.6% interest. And I'm thinking, wow, I'd rather bury it in my backyard. Thank you. So if you're a pension fund and you've got people retiring in the future and you've got obligations to be paid, you need a higher return than a savings account or even than the stock market. And so private equity historically returns almost double what the stock market has returned, for the same kind of length and time period. And so as a result of that, money keeps flowing in, more private equity firms get created, more funds are raised. And this year, 2022, for the first time ever, 50% of all merger and acquisition activity on the planet involves private equity now, on one side of the table or the other, or even both. So if you think about private equity, now you mentioned all these hundreds of thousands of companies that are owned by in the private space. A lot of these are family owned and operated, so somebody opened up a business, hung out a shingle, started to do a product or service. They developed this company and it's closely held by a family. That's a private company. There's no liquidity until you sell it. And so if you're not big enough to hit the public markets, but you need the liquidity and you've grown a business and you want to sell, private equity kind of steps in between, call it founder created business and the public markets, and then take companies from a relatively small size and grow them over a period of hold periods, oftentimes 3 or 4 different ownership periods with private equity as a company is on its journey from founder created to public company. And it's filling this niche need in market, and they're providing higher level returns than the stock market. And so again, mutual fund can buy this morning, can sell this afternoon, total liquidity. Private equity, I make a big commitment for a long period of time, absolutely no liquidity, and I'm sending checks to the private equity firm the first 5 years. I'm getting money back the next 5 years, but essentially money I commit is tied up for a 10-year period. So hopefully that makes some kind of sense as I'm rambling on here.
No, definitely. I see some people ask some questions. So if you got questions, please pile in the questions. I will bring them up towards the end. But I wanted to get into, you hit on some very key pieces. Now, how did you say the average private equity fund compared to the S&P 500? What is the return difference you said?
So in doing my research for my books, found a lot of great resources and essentially if you were to take call it a total stock market fund over a given 30-year period, the average rate of return is around 8% a year. And if you look at private equity, the average rate of return over that same 30-year period is double. And so as long as private equity continues to outpace the stock market, then for what you're trading to invest in private equity is you're trading liquidity for return. And it's of course a different risk profile as well. Some people would say private equity would be more riskier than the public markets. But in general speaking, if the total stock market's returning about 8 to 10%, it's actually ticked up a little bit in the last few years, the average return over 30 years. But private equity is almost doubling that return. And because there's limited places for people that have large amounts of capital to invest, because there's limited places for them to invest and get that kind of return that they're looking for, more and more money just keeps on piling into private equity, and private equity firms get bigger, more of them start. And, you've gone from, again, in my 21-year career, you've gone from under 2,000 to over 6,000 firms, and from under $1 trillion to over $5 trillion in assets under management. So phenomenal growth.